Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So our profit is the difference between our strike prices minus the debit. And to me, this is actually a more attractive risk versus reward scenario than actually buying that straight up call option, because what we've done is we've limited the amount of money that we're putting in. We're no longer putting 1082. We're theoretically putting in $4.53. So we've lowered our risk exposure, and also, even though we've limited our upside potential, recognize that we have the potential, if this is trading at or above 160 on the third Friday of January, to make almost, that's probably about 85% on our money. Okay, so keep that in mind when you're looking to participate. When options values are high, you can offset that volatility by creating this type of strategy. So again, we're buying the lower call strike, and then we're selling the higher strike to collect the premium, and the difference between those strike prices, that's what our profit is. Okay. So let's look at this on a chart and just see where we're more or less limiting ourselves with this particular strategy. So, for example, we're looking for prices to break above this 150 level. The idea is that as prices trade between 150 and 160, which is identified as sort of our first target, okay, we have the potential to make the difference between that spread. So provided that prices are at or above that 160 level, we will recognize the full profitability of that. Understanding, of course, that if prices trade any higher than that, we have given up our ability to profit. So we've limited our risk exposure, but we cannot profit any higher than the strike that we've initially sold. Okay. So any questions on that or comments, Steve, before I move into the put side of things?
Well put. I mean, I think that even the graphic representation is really great. I've never taught it that way, and I think it's probably better than I've ever taught. I mean, it just makes a lot of sense that you're buying it at that level, you're selling it at the other level, and you're locking that spread in. Theoretically, if it goes up to that strike price or higher, you're reducing your risk. Well put. Nothing more to add. And
just to kind of comment on Steve's suggestion with calls and puts, you either want to be really right or you either want to be really wrong. If you're really wrong with a straight call in this type of market, then you've exposed $10.82 to being really wrong. If you create a spread strategy in this type of market, you've only exposed $4.82 to being really wrong. Okay, so again, think of it in that context from a risk versus reward perspective. Yes, you've limited that profit potential to the upside, but in a market that's extremely volatile, you've now also reduced your risk exposure, in this case, by about 50%. Okay, so let's now move on and look at it from a bearish perspective. Again, same outlook as our put options. In this case, what we're doing is we're looking at, instead of buying just a straight put option, okay, we're looking at a break below a key pivot that we identified in the chart. Okay, and we're looking at buying our put option at a higher strike and selling the lower strike option to collect the premium, and that's going to offset our initial cost. Okay, the difference of that, again, exactly like the call, is the difference of that is minus our premium paid, or our cost paid, our debit paid, is going to represent the profitability of this particular opportunity. So here we're looking at one AUX, U.S. versus Australian dollar, January 2009, 145 put, as trading at $5.19. Okay, and this is the asking price. So this is, if I click the trade button, at a certain time today, this is what I would have been able to buy this at, because that's what the market maker was selling it for. Okay, so we're looking at buying the 145 strike. Okay, And at the same time, we're going to sell the 138.50 strike for a credit. And again, this is using the ask price, so this is us selling it at what we can sell it for right away in the market. So combined, that particular strategy now will cost us $336 or $3.36 as opposed to $5.19 or $519, okay? And our profit is the difference between our strike prices minus our debit. So what that equates to, that was the profitability. What that equates to is essentially having a limited risk of $3.14, but an upside potential of $3.36, meaning that you have the opportunity now to double your position with this specific example. Remember, this is an example. It's not a guarantee of results by any means, but remember, with this particular example, provided that this pair value is trading below 138.5 at or below on expiration, you're going to make the full value of your profit, which is $336. So for $314 risk, you're going to make $336 return if this moves in the direction that you've anticipated. I'm going to cover, just to answer Alan's question real quick, I'm going to cover that at the end of the presentation, Al. So just hang tight for a few minutes, and we'll get to that. Now, again, what we're doing is we're buying the higher strike, and we're selling the lower strike. We're offsetting our risk exposure. Yes, we're limiting our profit potential, but remember, in a market that is extremely volatile, as Steve mentioned, if we have the choice of being really right or really wrong, we want to limit how much we can be really wrong by. And by doing that, by creating this strategy, we're limiting that side of the equation. Okay? So again, let's have a look at it from a technical perspective, just to give you an idea as to what we were looking at. Ultimately, what we were anticipating is buying puts as we broke below these key technical levels. What I've done here is I've looked at selling a put option, a put option, which is essentially in and around the just above that 140 level, around the 142, okay, and buying it and then selling just below just at the 132 or 138.50. And the idea again is that we're essentially targeting a move down into this level here. So we're not even looking for a real significant move. Remember, guys, even if this comes down all the way down here and is trading down at the 120 level on expiration, we will always be able to make our profit between these two strikes. So we can essentially just sit on that trade and allow the market, as long as it's trading below that strike, allow time to pass by, and we always have the luxury of being able to identify this specific profit area right in here. So again, not looking like a huge area of profitability, but remember, if we can make our money in a very quick move based on this type of strategy with a limited amount of risk, okay, we have the chance to essentially make 100% on our money if this is trading below here on expiration. Remember, again, I'm going to stress that that's not necessarily a guarantee, but theoretically, this trading below here on expiration would mean that we would get to recognize the full profitability of this particular position. Again, we're giving up all of the profits that we could make without selling this put, but from a risk-reward perspective, we're paying less for the position, therefore we're risking less in the market, so that if we're wrong and this thing goes completely against us, we've only exposed ourselves to 50% of the exposure as buying that specific put option. Okay, so again, anything to add with this, Steve?
No, I think you're right on target, Jace.
Good stuff.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.